My name is Nurazira bint Hashim.
Hi, my name is Eza Natasha binti Muhammad Azan and I'm from TBA 243A.
Hi, my name is Nurida Nalisa binti Muhammad Nazri.
My name is Nuraina binti Dunia Azhar. I'm from GBA 2423A.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nina Achilan Zahid.
I will explain and share to you about the impact of yield curve based on the expectation and segmentation theory. Expectation theory argues that expectation about the future interest in contribution to the relationship between the yield and maturity, and consequently the deterioration of the curve. This theory assumes that instruments with the different maturities are equally attractive to investors who only care about the returns. Therefore, investors will buy and sell instruments with different maturities until the long-term rate reflects the average short-term rate is expected to occur in the future. The slope of the yield curve is generally positive because of the theory of expectation does not provide a satisfactory answer about this question, as it argues that a long-term risk will consistently exceed short-term risk only if the market consistently expects an increase in the future. However, such expectations do not make sense. It shows evidence that investors expect risk to go up and down with the same probability. Market segmentation theory states the yield curve is determined by the supply and the demand for the debt instrument with different time of period. For the example, if the current interest rates are high and then the future rates are expected to decline, thus increasing the demand for the long-term bonds by investors who want to lock in the high risk while lowering the supply. As a bond issuer, they do not want to be locked into the high rates. Therefore, the long-term interest rate will be lower than the short-term rate. On the other hand, if the current interest rates are low, then the bond buyer avoid long-term bonds until they are unlocked at a low rate, especially since the bond prices are declined as interest rates are rise, possibly if the interest rates are already low. On the other hand, borrowers usually want to lock in the low rates, so supply for long-term bonds will increase. Therefore, lower demand and higher supply will cause a long-term bond prices to fall, thus increasing the yield.
The assumptions of expected market theory is long-term and short-term securities are substitute, while segmented market theory states that long-term and short-term are imperfect substitute because they are traded in different markets. The expected market participants also buy and sell securities in order to maximum their profit, and there are no transaction costs in lifting costs in shifting between short and long-term securities. Then, in segmented market, the force of demand supplies in spread market in long-term and short-term will be determine the shape of the yield curve. I think that's all from me. Thank you.
I would like to talk about interest rate on bond of expectations theory and segmented market theory. The theory of expectations estimates possible short-term interest rate based on current long-term interest rate. The theory implies that by investing in two consecutive one-year bond investment, an investor gains the same amount of interest compared in investing in 2 years bond today. In concept, long-term rates can be used to indicate where rates of short-term bonds will trade in the future. Market segmentation theory is a theory that long and short-term interest rates are not related to each other. This theory assumes that market for bonds of different maturity are completely separate and segmented. For each bond of a different maturity, the interest rate is determined by the demand and supply of that bond. Longer bonds that have inflation and interest rate risks associated with them are entirely different assets than shorter bonds. So the expected returns for a bond of one maturity has no effect on the demand for a bond of another maturity. Investors have preference over another maturity for bonds with one maturity. If investors typically prefer shorter maturity bonds with less interest rate risk, then this explains why yield curve usually slope upwards. That's all from me. Thank you.
Now, let me proceed to the advantages and disadvantages of expectation and segmented theory. The advantages of expectation theory is it gives a fair understanding about interest rate to the investor. The disadvantages is the theory is not completely reliable and can give faulty calculation. Now, let's proceed to the segmented theory. The advantages is segmentation facilitates setting up of the reality selling target and priorities. But the disadvantages is when the characteristic of market segment change, the investment made might be useless.
So for the last part of this video, I'm going to explain an example of expectation and segmented market theory for more understanding. So for example of expectation theory, let the current rate of 1-year bond will be 8% and the investor expect that the interest rate will be 9% the next year. So the expected return for the 1-year bond will be 8 plus returns divided by 2 and we get 9. So 9% is the interest rate value for the investor to be willing to purchase. So here is the segmented market theory example. Consider as an insurance company. Life insurance usually take a long term as the maturity date is between 20 to 40 years. So when insurance company selling an insurance, they expose themselves to a long term liability. So to set off the liability, the company need to invest in an asset. The liability is a long term, so the company need to invest in asset that have a long term as well. An insurance company usually take a long term segment, and the reason is because they will not take risk when the interest rate is falling during the rollover. So there is no shift in the segment. Investors are fixed in a particular segment, and the yield is determined by the demand and supply of that segment. So that's it for the video. Thank you for watching.